For decades, the United Arab Emirates operated under a specific economic premise. It was a largely zero-tax territorial environment. If a business set up shop here, it was generally shielded from corporate income tax. That territorial model is straightforward. A state only levies taxes on the income generated strictly within its physical geographic borders. Money made outside those boundaries is effectively ignored. This highlights the alternative, the worldwide taxation model. Instead of looking at where money is made, a worldwide system looks at who makes it. It taxes the global income of its residents, pulling capital back to a central jurisdiction, regardless of where revenue originates. With the issuance of Federal Decree Law No. 47 of 2022, the UAE initiated a structural departure from its historical baseline. The state enacted a corporate tax regime that operates on a worldwide taxation model for its residents. The objective behind this legislation is integration. By adopting a competitive corporate tax regime that aligns with international standards, the UAE secures its position as a globally compliant financial center. Consequently, multinational corporations operating here cannot rely on geographical location alone to shield their profits. Entity structures must now be calibrated to account for global tax exposure. Under any worldwide system, the single most critical legal mechanism is residency. Establishing residency is the exact trigger that subjects a person or corporation to taxation on their global income. This concept has deep historical roots. Looking at this archival photograph of the League of Nations headquarters, we see where early coalitions undertook the first studies on global double taxation, concluding that tax jurisdiction should be allocated based on the source of the wealth and the residence of the owner. It is crucial to understand that tax residency is a strict statutory definition. It is not just holding a passport, having citizenship, or possessing a local trade license. Because each country writes its own domestic laws, those statutory definitions frequently clash. Two different sovereign nations might look at the exact same corporation and simultaneously claim it as a resident. Failing to rigorously analyze these statutory definitions creates immediate vulnerability. Overlapping claims of residency will result in accidental, compounding global tax liabilities on the same pool of income. To understand how the UAE manages this exposure, we start with the baseline rule. UAE resident persons are subject to corporate tax on their worldwide income. If a UAE resident earns income through operations in a foreign host country, both the UAE and that host country possess the jurisdictional right to tax that income. This creates juridical double taxation. To resolve this mathematical conflict, the UAE utilizes a specific mechanism, the Foreign Tax Credit, or FTC. This grid illustrates exactly how the FTC operates. Let's set the home country, the UAE, corporate tax rate at 9%. Now assume the foreign host country taxes that same income at a lower rate, say 5%, represented here as option 1. To prevent double taxation, the UAE allows the resident to claim a credit for the 5% already paid abroad. The UAE then levies a tax on the remaining 4% delta, reaching its 9% threshold without taxing the identical money twice. But watch what happens if we change the variables. If the host country taxes the income at 20%, the resident is paying more abroad than the UAE baseline. In this scenario, the UAE tax on that specific income drops to 0. Furthermore, the excess foreign taxes paid in that high-tax jurisdiction can actually be utilized as a credit to offset UAE taxes on foreign income generated in completely different, lower-tax countries. The foreign tax credit mechanism effectively equalizes the global tax burden for UAE entities. However, maximizing its utility requires highly sophisticated accounting to accurately track and apply these cross-border credits. This entire mathematical framework only applies if you are legally recognized as a resident. This decision tree maps out Article 11 of the Decree Law, which strictly defines who qualifies as a taxable person under two primary categories, juridical persons and natural persons. For a juridical person, a legal entity like a corporation, the first test is straightforward. Any entity formally incorporated, established, or recognized under UAE legislation is automatically classified as a resident. But there is a critical caveat. A corporation registered under the laws of a foreign jurisdiction is still classified as a UAE resident if its place of effective management and control is physically located within the UAE. Shifting to natural persons, the legislation applies a primary physical presence test. An individual is a resident if they are physically present in the UAE for 183 days or more within a consecutive 12-month period. A secondary test lowers that threshold to just 90 days if the individual holds a valid UAE residence permit or GCC nationality, provided they also maintain a permanent place of residence or carry on a business in the state. For unincorporated partnerships, the UAE applies a rule of fiscal transparency. The partnership itself is not taxed directly. Instead, the tax liability flows through to be taxed in the hands of the individual partners. The domestic nexus criteria cast a wide, precise net. Anyone with a substantial economic footprint or a decision-making locus within the country is captured as a tax resident. The primary exception to this standard worldwide tax base is the qualifying free zone person, established under Article 18 of the Decree Law. These specific entities benefit from a 0% corporate tax rate, provided they adhere to strict regulatory requirements and maintain adequate economic substance within the state. Looking at this structural boundary, the 0% rate applies specifically to income derived from transactions with businesses located completely outside of the UAE, or from trading with other free zone persons. The risk lies in triggering UAE-sourced income under Article 13. If a free zone person transacts with the UAE mainland and earns active business income, that revenue stream crosses the boundary. Maintaining qualifying free zone status demands absolute operational ring-fencing. Deriving active mainland income entirely disqualifies the entity from the 0% tax regime. This rigid framework inevitably leads to a paradox. What happens when the UAE's domestic laws and another sovereign nation's domestic laws both legitimately claim the exact same taxpayer as a resident? To resolve this, states rely on double taxation avoidance agreements, or DTAAs. As seen in this view of the OECD headquarters, these international treaties are generally built upon the OECD Model Tax Convention and serve as the ultimate legal override to domestic law. For natural persons caught in dual residency, Article 4 of the Convention provides a strict hierarchy of tiebreaker tests to assign a single final residency. The authorities cascade through the criteria. First, they check the location of a permanent home. If the individual has a home in both countries, they look to the center of vital interests, where personal and economic ties are closer. If that is still tied, they evaluate habitual abode, and finally, nationality. This hierarchy is designed to systematically filter out competing jurisdictional claims until one sovereign state retains the legal right to tax the individual's global income. For juridical persons, companies, and legal entities, the ultimate treaty tiebreaker rests on a single concept: determining the entity's place of effective management. Place of effective management is not where a company's incorporation documents are filed. It is the physical location where the key management, commercial, and operational decisions necessary to conduct the business are actively made. This concept is deeply anchored in international case law. This archival view of London grounds the 1906 British ruling in De Beers Consolidated Mines versus Howe, where the court established that real business location supersedes foreign registration. In that case, a mining company was formally registered in South Africa, yet the House of Lords deemed it a United Kingdom resident for tax purposes, purely because the directing power and chief operations were controlled from an office in London. That precedent holds true today. In the modern Bywater Investments case in Australia, the court ignored passive directors residing abroad because the true, substantive commercial decisions were being made by an individual sitting in Sydney. In the modern UAE tax landscape, legal incorporation is no longer a shield. Actual substance, physical presence, and the true locus of strategic decision-making dictate your ultimate tax base.